Join your host, Maddie Roach, as she brings you into a community of fee-only financial advisors who are successfully building profitable businesses that serve the next generation of clients. Learn from innovative advisors whose unique stories will inspire you to dream big and take action on your goals. Are you ready to live your best life and help your clients live theirs? Then you're in the right place.
Hello, and welcome to XYPN Radio, episode 323. I'm Maddie Roach, your host. For the past 4 years, XYPN has conducted an annual benchmarking study, a comprehensive survey that gathers core performance indicators of member participant firms and ultimately draws conclusions about the success of different business models, fee structures, and niches. On today's episode, Moore and Michael Kitces, XYPN Co-Founders, discuss this year's 5th annual results. And you'll see, with our maturing network and maturing member firms, the study is showing a much clearer understanding of what's working and what's not working in fee-only RIAs. Like every year, this episode of Alan and Michael talking about the benchmarking study is particularly interesting and helpful for those of you who are considering starting the long play of the entrepreneurial journey, as well as those who have already begun it. I encourage you to listen closely and then go back to the previous conversations about the surveys in years past and use them as resources to build your ideal firm. If you're interested in what really works, yes, meaning proven with data, when it comes to building your firm, then this show is for you. Without further ado, here's Alan and Michael's conversation about XYPN's 2021 benchmarking study.
Tax planning and preparation is an enormous value add for your clients, but taxes can very quickly become overwhelming as an advisor. XY Tax Solutions is the tax team in your corner that works with advisors to offer expert tax services to their clients with 3 different client engagement options to choose from to meet your unique needs. Partner with XY Tax Solutions to integrate tax preparation and planning into your firm, and don't sweat tax time this year. Visit xyplanningnetwork.com/XY Tax Solutions to learn more. Also, be sure to go to xyplanningnetwork.com/VIP to join our private group just for XYPN radio listeners. It's a community of advisors we've all been looking for that's there to provide support when we need it the most. Best of all, it's free. I encourage you to check it out. Again, that's xyplanningnetwork.com/VIP.
Michael Kitces and Alan Moore here today with you. It has been a very long time since we have recorded a podcast episode together. It's possible it has been approximately 12 months since we recorded our conversation last year talking about the benchmarking survey. So, Michael, welcome to XYPN Radio.
Thank you, Alan. It's good to be back. So just out of random curiosity, what do you think we're going to talk about today?
I'd say we're going to talk about benchmarking survey results. Very excited to be talking about the benchmarking study. Every year, we do a survey to our members and collect data on a variety of topics related to revenue, expenses, growth rates, types of clients, where their focus is, all of those sorts of things. And we work with a third party, statistical analysis team that this is what they do, is help pull all of this sort of thing together. And they've helped us sort of aggregate the data, really look at it, be sure that we're sort of telling the story, looking at the data correctly. And so excited to bring, I think this is our 5th year doing this, if I'm not mistaken. I'm trying to think. I think our first conference we did this at would have been San Diego. So that was 5 years ago. So anyway, without further ado, we'll kick off in sort of talking through this. So we're going to put the charts and graphs that we talk about, we will put we'll put online so you can go look at that. If you are a member or came to the conference, then you will also be able to get, you can just pull it up, either PDF or print version if you have that. And so we'll be talking about the figures. I will do my best to draw them with my words. I know that's not always fun when it comes to statistics, but we will do the best we can since we're talking about it here on the podcast. So I guess to kick things off, Michael, before we dig into any of the specifics, just like high level, what did you learn this year from this study? Like what did this study ultimately tell you?
Well, so at a high level, I think to me, by far the biggest news of the study was just, XYPN is heavily focused on this fee-for-service model. I feel like the question always and forever has been, but what happens when there's a recession and like people are laid off, and do they cut their financial planners? Do they cut their subscription fee planners because they're trying to save money in a recession? What happens? And so, just to me, the biggest high level result here, like this is the 2021 benchmarking study with the 2020 data, otherwise known as the pandemic year. And the answer is like, firms didn't blow up, like revenue didn't go backwards. It continued to grow and chug along. There's a little bit of indication that for some firms maybe grew a little bit slower, particularly if they were still earlier stage and hadn't quite hit the traction in their niche yet in the first place. And we'll talk more about growth and traction niches later. But, ever since XYPN launched in 2014, I feel like one of the most common refrains I've heard is like, yeah, but let's see what retention looks like in a bear market. And the answer was retention looked fine in a bear market. Like people still want advice when their finances are going crazy. And that holds in subscription models as well as others. And so just firms grew, they did fine. Like the sort of the forecasted blow up risk of fee for service models in recessions, it just didn't happen. I don't know if that's a forever guarantee or anything, but it didn't happen.
Yeah, I mean, I agree with you. This is saying COVID was tough. COVID sucked for everybody. However, a lot of financial planners and many of our members did still, well, pretty much everyone grew. Some of them grew very well. Again, a little bit slower maybe than in years past, but members still grew. The second thing we have to recognize is that one, probably not fair to call it a bear market. It was the shortest bear market maybe of all time. Just you saw the quick dip and then you saw it come back. But obviously the recession that we went into in 2020 did not impact the typical client profile of an XYPN member either. And so unlike a 2008 that really did hit a lot of your higher income middle income earners, COVID really crushed our sort of your
service industries, hospitality industries.
Yeah,
but not so much the white collar worker that, at the end of the day, I think is where financial planners tend to skew a little bit more, right? Just higher income, little more financial decisions, little more financial complexity, little more financial wherewithal to hire a financial advisor to get advice about the complexity and challenges. And true, to be fair, like that was a segment that weathered this storm particularly well, at least just from a job stability end. Work from home was challenging for many, balancing your professional services work and your kids who were doing kindergarten out of your kitchen like mine were. But they kept their jobs.
Right.
And they had their income more so at least than others. There were still layoffs and some downsizing, but they kept their jobs, they kept their financial advisors, and they're still chugging along. Like members grew.
Yeah, absolutely. Well, let's go ahead and dig in. So we've got a few different figures and charts and graphs we're going to be talking about, but we'll kick off with figure number 1. Seems like a great place to start.
That seems like a good place to start.
If you have the PDF version, it's page 6, I believe.
With the infamous, it's page 6 of the document, but page 4 on the thing because the cover page doesn't have a number. So
exactly.
Sorry about anybody who freaks out about the whole page 6 says page 4. It's page 6 of the PDF, page 4 if you're following the numbers on the document.
Yeah. So, and this is a graph that I believe we showed for the first time last year in our benchmarking survey or benchmarking study. And this is articulated a little bit differently than it was last year. So if you just look apples to apples from last year, the data got sort of just sliced a little bit differently. So when you're looking at it, don't be surprised. But basically, this chart is showing us for all of the advisors who joined XYPN with either none or very few clients. All right, the way it's worded here is that fewer than 10% of their clients were clients whenever they joined XYPN. Basically, like who started from scratch.
Right.
Because we want to be able to give a realistic picture to folks who are thinking about launching a firm of what does year 1, 2, and 3 really look like so that you're prepared. All right, we would much rather you be prepared to launch a firm and wait 2 or 3 years, get your income in order, assets, all of your debt payments, all of those things, right? Be ready financially, than to launch a firm, be surprised, and then ultimately not be successful. And so trying to give that realistic picture of what those early years look like. And so what this shows is, for someone who joined, who this is their first year, how much money did they make? And for someone who this is their second year, how much did they make over the last 2 years? So how much they make 2019, how much they make 2020, all the way up to 5-year members, and how much did they make per year for each of the last 5 years, to really just show that sort of progression of income. And I would say what we found was pretty consistent with years past, which is the first 2 years suck, right? The first year is really bad. The second year is tough. And by year 3, you start to hit that sort of the holy grail of replacing your pre-quitting or getting fired salary.
Yep. And it has been interesting in kind of seeing the ramp up of how this is going. So like if we look at our 5-year members, their journey was like just basically like nothing. Like they got a client who paid them a fee once. By year 2, they were at $13,000 of revenue. By year 3, they were at 66. When we look at our 4-year members, the path has accelerated a little. $12,000 in almost $13,000 in year 1, up to 60 by year 2, up to 90 by year 3. When we look at our 3-year members, we're seeing it pick up even a little bit more. $13,000 in year 1, $62,000 in year 2, which is similar, up to $120,000 in year 3. And as we'll share in some of the stats later, one of the biggest differences that we're seeing in practice is members are niching earlier.
Did we have to go to the niche already? I was going to try to avoid that until
we're going to get there later, but just it's the difference that we're seeing. The members are niching earlier than they did before, and they're growing and gaining momentum faster than they did before. With the caveat again, like year 1 sucks for everyone. Mm-hmm. It's still a 5, 10, 15,000 gross revenue year, which means you're probably 0 or negative after the expense of getting started with the business. But they're getting more traction faster in year 2, and they're getting a lot more traction faster in year 3. We're seeing that pace accelerate.
So in here, it says, the 1-year members, they made $24,000 in their first year, whereas those who have been with us 5 years, they only made $2,000 in the first year. What do you make of the difference between $2,000 5 years ago to $24,000 this year? Do you think that's a discrepancy in the data, or I guess what's the story there?
My gut is a piece of this again is just we're getting clearer about the value proposition. To be candid, I'm skeptical how many members are really like drastically ramping up their their niche growth right out of the gate, literally in year 0. Although I will say, at least anecdotally, I'm seeing that a little bit more. Some advisors that are joining, particularly those who are joining from like career changing and starting in the industry, not necessarily coming out from another firm, who are figuring out what niche they're going to go after before they even launch, and they actually start laying the groundwork in the pre-launch phase. Maybe they're getting involved in that community or getting involved in social media with them, or like starting some blog or thing, so that by the time they launch, they actually already have a little bit of presence. But my gut as well is just, I think for the whole financial planning space in the aggregate, we're just getting at least a little bit better at explaining what the heck financial planning is and what we're going to do for you, right? Like, bless the soul of the people who were starting this 5 years ago, but there were there were very few advisors in XYPN. There were very few advisors doing fee for service. Like, there were no models. No one was talking about client service calendars. No one was talking about how to show the value of ongoing financial planning fees. At best, it was like, well, I'm gonna make a comprehensive financial plan for you. It'll be a little skimmed down so that it's not too expensive, and like we'll do these quick start plans and try to get going. Like, that was the model then. Now we're seeing a lot more of, I know what I'm doing. I know what I'm offering. I've already put together a client service calendar that explains what I'm going to be doing. I'm clear on my fee structure. I know what I'm offering out into the marketplace. And I can believe that also is just getting a little bit more revenue growing quickly. I don't think this is ever going to be a like, we get so good at launching firms by understanding fee for service that advisors can just do like $50,000 or $100,000 of revenue in the first year. Just failing anything else, even as we get better at describing our value proposition and the rest, it takes time to get established. It takes time for just, your community of wherever it is that you market and show up for, as the saying goes, people do business with people they know, like, and trust, and who have a decent service for sale. So like, we're getting better at the decent service for sale and how we explain it. But you can only get people going so fast. You can only show up the first time at a meeting so many times and have someone say like, well, I've never seen you before and you're basically a total stranger, but it seems like you know what you're doing. Let's just do my comprehensive financial plan right here. Like, it still takes time. It still takes some time.
Yeah, I also wonder if some of this is telling the story that advisors are more ready to launch a firm when they're joining XYPN. Very early on, I was certainly guilty of it, of sort of sometimes overselling and not intending to, but just being really excited and
You
telling
were
people
just
how great it was.
you got people overly enthusiastic.
Exactly. And so maybe some folks launched businesses before they were really ready and they weren't sure what their target market was going to be. They hadn't spent much time focused on that target market. They're getting distracted with side hustles because they have no income. They don't have enough cash in the bank. So they're spending half their time doing other stuff instead of out getting clients. So I also wonder if just, the advisors who are joining, I guess these are folks who joined in 2019. Those who joined in 2019, their 2020 revenue was really they were more prepared to ultimately launch a firm.
And I think the broader thing that just we're seeing overall, and I'm curious to see whether or how the numbers hold for this next year as well, is just historically it was basically you had to get to year 4 before you crossed 6 figures of income. Like it took getting to year 4 to get to $100,000 of income. And now we're seeing members getting there by year 3. I mean, they were creeping higher. Like the 5-year members were only at 66 grand by year 3. The 4-year members were at 90 grand by year 3. The 3-year members now got to 120 grand by year 3. So the ramp up pace seems to be getting a little bit faster as well. And again, I don't want to project that indefinitely. Like, well, if this trend continues by a couple more years from now, you'll just make $100,000 in your first month. Like there's gonna be some leveling off to this, but I do think we're seeing this fundamental phenomenon that just as advisors get clearer about how to launch, what it takes, how to get off on the right footing, how to get focused on your marketing, your offering, and refine it in more quickly, that the time to get back to $100,000 of gross revenue is coming down. It is getting faster.
Yeah, I mean, basically, we're saying like success is guaranteed. And again, just to reiterate, we're not here to paint a rosy picture of the difficulty. This is showing the numbers of average revenue of those who are joining with no clients. If we showed you those who are joining with substantial clients, like these numbers are astronomically higher. Right. But this is from scratch. What does this take? And the answer is, to your point, we're now earning in year 3 what we used to earn in year 4. We're earning in year 2. What used to take almost 3 years to get to, or sort of on that path. So, you should still plan on year 3 is when you will take a breath. All right. The first 2 years are just tough. They're grindy. That is part of it. But I also think it's interesting. So figure 1 is also figure 19. It got pulled up sort of into the executive summary. But then figure 20, so down on page 20 or numbered 20, there, we separate members into 4 distinct groups to help us sort of classify where they're at in their business. We have the preparing members. They have not launched an RIA. They are getting ready to launch. Once they launch, we call those advisors implementing. They are implementing the business plan. They're implementing their RIA. They are getting started. So these advisors, by definition, have 1 to 20 clients. Okay, so 20 or fewer clients. Then they move into the building phase. This is when you start to get a little busier, right? That you're starting to see more clients, but you're doing a lot of. I mean, you're still doing everything because you haven't yet hit a revenue point where you're able to bring in outside staff, or not a lot, and things are getting busy. You're starting to refine your process, but you're really building that firm. You're starting to grow, and then when you hit 75 clients, you move into what we call the scaling phase. Now, scaling then gets broken out into a couple categories. This survey, this study sort of groups everybody in scaling into one group, but scaling then gets sort of separated out into the solo practice. I never want to hire anyone full time. I just want to be, it's just going to be me. We have the boutique firms, which are sort of that 1 to 20 employee size firms that I want to grow, but I don't want to grow too big. Then we have the enterprise. And so just for some sort of, I guess, to sort of set the stage here. And what chart or what figure 20 is telling us is revenue growth rate for those who are in the implementing phase, the building phase, and the scaling phase. So again, implementing sort of that 1 to 20 clients was pretty substantial. On average, they brought in almost 10 new clients, which is a lot. And they brought in, I guess it's showing 85% revenue growth. The building phase, so that 20 to 75 clients, they brought in 23 new clients on average, which is a lot. I mean, that's 1 every 2 weeks. I mean, that is a lot.
Yeah. Two a month. Like you get known and things start moving.
And then by that scaling phase, they're growing by 31 new clients a year, which is really high. But the number that's really interesting down here is second from the bottom, and that's average client size, average revenue per client. And if we just compare implementing to scaling, our scaling members, who by definition have been in business probably at least 3 years, maybe 4, so they're capturing that 4 to 5 year membership, their average revenue per client is $2,700. For the implementing members, who are a lot newer in their business, their average revenue is $3,700. So $1,000 more per client, which I think speaks to what we're talking about as well, is it's a lot easier to make a lot more money in that year when you bring on 10 clients. You just make an extra 10 grand when you charge those 10 new clients an extra $1,000, right? And they probably had some clients coming in as well. So that just extra $1,000 per client, I guess we're saying on average they had, or we're not showing total number of clients here. That's somewhere else in the survey. But either way, like you're probably bringing in an extra 15, 20 grand just because you're charging $1,000 more. So do you think that's telling the story and sort of that's a big part of why we're seeing that higher revenue in the early years?
Yeah, I mean it's well, it's two things. So it's that I think we're just getting better clarity about the offering and what we're doing, so that we're feeling a little bit more pricing confidence early on. And when not to keep beating the drum, that's gonna become more of a drum beat soon. But just early members are niching faster. They're getting clear on their value proposition earlier. And one of the things that we see pretty consistently in the study, and we have year after year as we've done this, is that firms with niches do a lot more retainer revenue, or just they're able to command higher fees and they're able to get more retainer clients. And so as members build niches earlier, they're getting more pricing power earlier. They're able to charge more earlier. And I think we're starting to see it show up outright in the data here in the implementing phase, the point that, I think you'll get to it soon, but this is the first year that we saw where members with niches are outgrowing members without niches in every single phase, including even in the implementing launch phase.
Yeah. It used to be that, and sort of the theory was, well, the niche firms take a little longer to get going because, you're not able to work with family and friends, but we're starting to see a little bit of a trend away from that. So yeah, let's jump. We'll go back up to figure 2, okay, just so that we can, look at what we're talking about here, which is sort of the power of a niche. Now, Michael and I have been talking for years about have a niche. And really, I learned all about niches from Kristen Herod, who is a marketing consultant in our space, and she used to say, go small to grow big, and get really well defined in your target market. And historically, we have seen that niche firms outperform non-niche firms over time. But again, those first 2 years, they are behind a little bit in terms of revenue. That is not the case this year. So again, sorry to sort of paint the picture with our words when it comes to the data, but this again it breaks out implementing, building, and scaling firms, and then niche versus the firm that does not have the niche. And for the implementing, so this is newer, so revenue growth. So Michael, this is new revenue, not necessarily total revenue. Is that accurate?
Correct. This is new revenue that got added in 2020. So depending how large your firm was when you entered 2020, right, just like how established you were, how much new revenue did you manage to bring in, and kind of broken out by, were you doing that where you were in a niche, so majority of your focus was in a niche, or were you doing this as a no niche generalist?
And so for those implementing members, the 1 to 20 clients, those who were in a niche brought in about $11,000 more than no niche. So 28,000 versus 17, which is pretty substantial. I mean, that's 70% higher revenue. Trying to do that math in my head. They brought in 70% more revenue. The building phase is a little closer. They brought in about $3,000 more. So 42,000 versus 39,000. The scaling is hugely different, which is what we've seen in the past. And so the scaling members brought in about 50,000 more than those who were in than those who did not have a niche. So they brought about 120,000 versus the no niche, which brought in 67,000. This just continues to reiterate the point of just the power of a niche. And again, we've always seen this in the longer term. This is the first year we're really seeing this very early on. And again, I think this points back to advisors are coming, to XYPN to get launched already with an idea in mind of who their target market's going to be. They've already been building out that network. They're not starting from day one like, you know what, I'm going to work with pilots. Like, do you know any pilots? No, I don't know any pilots, but I'll figure it out. Right? They're coming in with a network of pilots. They've already been talking to the centers of influence. They've already been blogging, creating content, whatever those things are. They've already been doing is what I'm seeing anecdotally, and I think that's what we're seeing in the data.
Yeah, absolutely. It's just, and I think you frame it well. That just for so long the viewpoint was something to the effect of, I'm just getting launched. I don't have the time to focus in on a niche. I just need to get anyone. And what we're seeing in the data and practice is it's hard to get anyone. Like, it's hard to get anyone at any point. Like, even when you're getting started, perhaps especially when you're getting started, and no one knows who you are and what you do and what you bring to the table and why they should work with you and why they should give you their life savings and depend on you for financial advice, and all those weights that we put on our shoulders when we're getting started and the imposter syndrome's kicking in. We make that worse for ourselves when we don't have any clarity about who we serve and what we and who we're going after. And the members who are starting in a niche, who are getting clear, are getting there faster. Right? At worst, is Philip Palaviv, I had once heard it framed this really well. I'm gonna. Philip is wonderfully witty about what he says. I do not have his wit, and I don't remember exactly how he frames this in his beautiful witty way. But something to the effect of, the fastest way to become the leading expert at something is to pick something really small. Like, the fastest way to become known and famous in something is to get super focused on what you're going to be known and famous for. Because if you want to be famous for like everything, comprehensive financial advice for everyone, like, good luck taking down Susie Orman and Dave Ramsey and all the rest who have these giant media platforms. But if you want to be, the leading expert in Chick-fil-A operators, the leading expert in, ophthalmologists who are building up their medical practices for sale, you can get super focused into a particular thing. All of a sudden, there's only like 3 other people in the country who ever deal with those clients. So you don't have to beat 300,000 other financial advisors. You just have to beat like 2 who are in a similar market to you. And if you get even more focused than they are, you literally have to beat no one, because there's no one else that shows up in the particular market that you're focusing in. And so the more focus that we get out of the gate, the faster we're seeing firms get going and sort of exposing what I think is this myth of, well, I'm just going to get anyone who has a pulse and then I'll get around to building a niche later. What we saw in the past was doing that puts you way behind by years 3, 4, and 5, because the niche advisors who spent 3 years niching had like a slingshot effect on their growth, and everybody else who was a generalist had to just start getting started on their niche. And we still see that here, right? As you noted, for members who've reached the scaling phase, if they've got a niche, they're growing by 120,000 of new revenue per year. And no niche advisors have barely half that. But now we're seeing it come all the way forward, where if you're getting clear enough on who you're going after, higher fees out of the gate, more growth out of the gate, more new revenue out of the gate. It works from day one, because it's hard. It's a crowded space. It's hard to stand out. And if you can be the absolute best at something, and I know most advisors when they're getting started, like, I feel like I'm new and I'm not the best at anything. But that's the point. The more focused you get, the easier it is to actually very quickly get to mastery of something, because you're not biting off everything. Like, you just be awesome at like one thing for one group and then just show up for them.
No, it's so true. And I think, anecdotally as well, without pulling all the data, at AdvicePay, we see, I believe, that the 5 fastest growing firms in terms of transaction volume on AdvicePay, all 5 of them are deep into a niche, and 3 of them have their niche in their name, like their company name. That's how deep into that niche they are. And so we're seeing this from all sides. It's just how fast these firms are starting to grow and how fast that traction really does pick up. And the truth is, like, again, that's how you can build a really successful boutique style practice. Now, if you want to build an enterprise practice, we can talk about, do you have multiple niches, advisors with different niche markets, all that sort of thing. But if you want to build a super fast growing boutique firm with 1 to 20 employees and really run that as a business, that's how you do it, is you ultimately pick a niche. Because if you're going to go super broad generalist, you better become an enterprise or you're going to get crushed because there's no differentiation. So,
yep. And I think it's also worth pointing out, just in that frame, and everybody's got their own income goals and their own business goals, but just the other thing to note for that, because it's the other latent fear that I always see and hear for advisors that are thinking about niching or not, or whether to niche, or just like, like, how do I know if there's enough of them? How do I know there's enough clients to build a business that just, it basically only takes 50 great clients, or like, how do you make several $100,000 a year? 50 clients paying $5,000 a year. 50 clients paying $400 a month. Like you're gonna gross almost $250,000. You can probably handle 50 clients solo, and you're gonna be netting north of 200. Maybe you can go to 60 or 70 clients, generate more than 300,000 of revenue, and hire an assistant, and you'll still be making $200,000+. So for those that want to make much bigger numbers, at some point, either you have to scale the firm bigger, or you just have to get more affluent clients that write bigger checks, or some combination thereof. Yeah. But the path to six-figure income, and like the path to six-figure income that doesn't start with a one, it's at least got a two handle on it. Like you can do that with 50 great clients. Frankly, you can do, some advisors I know do it with fewer than 50 clients.
30 to 40, depending on what they're paying you per client.
Depending on what they're paying you. But like the path to higher fees is being more specialized, right? Just any profession out there anywhere, the specialists get paid more than the generalists. And it's showing up the same way in the financial advisor world as well.
Yeah, and just the power of a niche, it's so, it's easy to think like, oh, it's just marketing, or, it's just a sham or whatever. Like, does it really matter? But I mean, no matter how we slice the data, we uncover sort of all of these things that are saying like, no, this is really important. And so, if you go down to figure 12 on page 12, that's I keep saying that
it's amazing how well that keeps working out.
What this chart is showing is over time how sort of the advisors who say, I have a niche, then we say, okay, well, what percentage of your clients are inside that niche, right? Because they could be 1%, it could be 100%, but somewhere in between there. And so this is showing that the firms, sort of the percentage of their clients they're getting more niche-y, if you will. Yep. So, back in 2016, of those who had a niche, 47% of the clients were inside of that niche, whereas this most recent year, 67% of clients were inside that niche. So a 20% overall increase, almost a 50% difference. And so let's say 2/3 of the clients are inside the niche. And what we're also seeing is that prospect to client close rates are just climbing astronomically as well. So you want to speak to that, Michael?
Yeah, we see this evolution just as firms get more focused into niches, the percentage of their clients in niches goes up. The focus in their niche goes up. Their marketing tends to get focused more on their niche, right? If only 10 or 20% of your clients are niche, you usually feel scared like to put the niche in your firm name and on your homepage. When 60, 70, 80% of your clients in your niche, you usually like put it out there pretty proudly at that point. And so the more that firms are focused in the niches, the more they get known in their niche, right? They market it better. They market it more confidently. They just literally get more word of mouth in their niche because they've got more people in their niche. And the more they get focused in their niche, the higher the close rates go, because now you really are the perfect advisor for your ideal client who knows exactly how to find you, because every other advisor who's a blank seems to work with you as well, right? Blank is whatever your niche is. So we see this interesting parallel that the more advisors get concentrated in niches, the more their close rates go up. And so as the percentage of as advisors, the percentage of clients in the niche has gone from 47% to 67%, the close rate for advisors has gone from 40% to almost 60%. It's like they've both gone up almost 20% in parallel. The nichier the advisor, the higher the close rate of the clients that they're working with.
Yeah, I was trying to see if we have the data this year for number of prospect meetings that advisors are doing over time, but I don't think we have a chart that shows that. I think we just have sort of the 1 year.
Yeah, we didn't separate out in the data. So we have some data on prospect meetings and close rates, but not separated by niche versus non-niche.
And so just to sort of see, like, what this is also telling me is that, firms you're meeting with the right people when you have a really clearly defined niche, right? Mm-hmm. It's easier to spread the word. You're much more referable. It's easier to work with you, to know that I'm the right client for you, I'm the wrong client for you. So just overall top of funnel awareness is much broader. It's much easier. your marketing efforts are so much more well defined. Your money is being spent so much better, I guess, from a marketing standpoint. But then also when you are actually meeting with those clients or those prospects, it's just much easier to define the value proposition, and we're seeing those higher close rates. So again, it all makes sense. It's terrifying to have a niche. I get it. Like if you walk in, you're like, I have this really well-defined target market. I already know what I'm going to do. It feels so obvious. It doesn't feel scary. I understand that if you're sitting here like, but I don't know the niche I want to serve. Okay. I know that's scary and that can be hard to work through. But I would encourage you to know that like, that is really, really, really important. And so we're going to talk about one more sort of niche focused conversation, and then we'll shift. So we're going to go to, let's see, we've got my page scanned here just a bit. So we're going to table 6, page 23. I guess actually page 21. And so this is showing sort of sources of new clients based on your phase of business. So if you're in implementing, you're in building, you're in scaling, and where your new clients are coming from. And there's a wide range of things here. XYPN's Find an Advisor profile, NAPFA, Google search, sort of all these various places. So Michael, you want to talk about sort of how you're seeing sort of what this data is telling you about where clients are coming from for these advisors?
Yeah, this was really interesting data to me this year. We hadn't quite looked at it this way before, of just how does the business development strategy of advisors change over time? So some things were sort of pretty obvious and not surprising. Like, it turns out the larger the firm, the more of its growth comes from referrals from existing clients. You're like, well, yeah, no kidding, because I don't really get a lot of referrals from existing clients. I don't have any clients yet because I'm still in the implementing phase, or I've got very few. So no great surprise. The more clients a firm has, the more referrals that they tend to generate. Conversely, advisors in the very early years, when they just don't have much established for themselves, end up spending a lot of time just doing the general networking business development thing, right? Like, just get out there and meet people and shake hands and get introduced. And as firms grow up to the scaling phase, those numbers fall way, 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 way off. We'd see them come down dramatically. But there were a couple of differences in the data we found that was very striking. And I think it's entirely to, yes, as we found, like, so when advisors are getting started, the ones that have niches get started faster than the ones without niches. But even if you're focusing to a niche, like, you still have to get known for your niche. Like, you still have to go out there and do things. People don't necessarily know how to find you or find their way to you yet. So you've got to establish yourself, whether you're going through a niche or not. You've still got to establish yourself. And so a lot of the marketing activities still look similar. Lots of networking, lots of trying to work with centers of influence, just the things we try to do to get the word out about us. The scaling members, though, what we see is, when we look there and we see the growth of what happens with firms that increasingly are niche-based and established in their niches, we see some really significant shifts. One of the most striking parts is growth from Google searches goes up dramatically. Less than 10% of growth for implementing advisors comes from online Google searches. Almost 25% of new clients for scaling advisors comes from Google searches, because now they're known for a thing. So, if you're an ophthalmologist selling your practice for a private equity firm and you start typing that into Google, like, you find Adam Schmela, the guy who literally works with ophthalmologists who sells their firms to private equity. So you start getting known and actually findable online. One of the other big striking things that we saw in the data this year is that almost 20% of growth for scaling advisors is coming from online ads. Mm-hmm. So Google ads, Facebook ads, LinkedIn ads, other more specialized sites where they're doing online advertising. But again, once you become known for a specialty, it gets much more straightforward to go to exactly where those people are, hyper target them, and put your known message in front of them. And when you're established and known, people tend to like see the name. Oh yeah, I've heard of that guy or gal. Like, I know they're pretty good. Oh, I've got a problem in my life. I think I actually need to reach out. And there's your ad. And so, like, online ads was basically 0% of growth for implementing advisors, but almost 20% of growth for scaling advisors. And I don't think that's just a function of like the ads are working for scaling and failing for implementing. But, as you get established, you both have a greater presence to be able to market. And frankly, you have a little bit more free cash flow because of the growth that you can reinvest into your marketing. And so I think we're seeing that cycle begin to feed, such that for scaling members, almost half of their growth is online Google searches and online ads, finding them in their niche.
Yeah, and you start to layer in, XYPN, Find Advisor, NAPFA, also all online. Also, XYPN, very niche focused, obviously, with our search engine. The vast majority of clients are coming from online. I mean, you also see an increase of referrals from existing clients because scaling members have more clients to refer you, as well as, you've had a longer relationship with those clients. So therefore you can start to get some of those client referrals that takes time.
And one of the other things that struck me about the data, even and especially with respect to XYPN's Find an Advisor profile, the implementing members, barely 2% of growth came from XYPN's Find an Advisor profile. Scaling members, almost 9% of their growth, like nearly 5x the growth rate, came from XYPN's Find Advisor profile. And of course, 5x the growth rate, and like scaling firms are larger, so it's a bigger denominator, which is like the number of clients is actually significantly higher that they're getting. And Alan, like I know this was something that we had been looking at some separate data internally and talking about with respect to XYPN's Find Advisor profile, which is the member profiles getting the most searches and activity in Find an Advisor are the nichiest members.
Yep,
it's not the generalists. And right, and I mean, like that's sort of pretty straightforward. Just there's I don't even know how many advisors and members in total now on the Find Advisor page in total. I mean, just hundreds and hundreds of members,
over 1,000, I believe now. If
you don't have a thing that comes up in the search, like some niche, something that you're going after, I mean, just literally, like how would a prospect find you? I mean, even if they went to XYPN's Find Advisor, like what
else? Yeah.
Right. I mean, just at some point, there's a list of 1,000 names and they have to enter something to find you, to find you, to have you come up as a result amongst all the others. And so the members that have a niche, at some point, someone puts in doctors, dentists, government employees, millennials, fire community, whatever, is all the different niches that we've got listed on the site. And if you don't check any of those boxes, there's no box for someone to check to find you. I mean, the only way that you typically end up coming up, and I mean, the truth is how most advisors have been found on Find an Advisor portals since forever, is location search, zip code.
And guess what COVID did for us.
Yeah.
They accelerated that trend.
Yeah. And so, just recognize, like in practice, if you are a generalist, the truth is that the number one way that that clients are filtering to find you is your zip code. Just for clients who basically say, I have no idea what I want, and I can't figure out how to differentiate any of y'all advisors anyways, I'm just going to pick the one that's geographically convenient to my house or office. I guess if you live in an area that's either dense enough with opportunity or sparse enough where there's no other advisor within 10, 20, 30 miles of you, which I know was in the early days actually how a lot of NAPFA advisors grew.
Absolutely.
Like, they would have a location-based search and they were the only NAPFA advisor in a 30-mile radius. So they got basically anybody within 30 miles of their office. But, unless you were really trying to build a firm where your zip code is your primary differentiator, like prospects need some way to filter to pick you out from all the other advisors who are out there. And what we're seeing is the nichier the advisor, in particular, the more established the niche advisor, the more findable they are online. And so we see it in online ads, we see it in online Google searches, and basically we see it even in XYPN's Find an Advisor profile, that almost 5x the growth rate for scaling members who have become more established in their niches than implementing members who haven't gotten it out there yet.
Yeah, this is further reiterated for those of you with the benchmarking study. You can go down to table 7, and it actually splits out niche versus non-niche. We've been talking about sort of different phases of growth. But table 7 really breaks out, XYPN's Find an Advisor profile, Google searches, overall just in speeches, seminars, community events, and then general networking and business development. And yeah, anything online goes way up with a niche. And when you don't have a niche, you're sort of left with generalized business development, which can work. It can be effective. But it is a lot easier to market and to do sales when you know who you're talking to. Okay, so we've got two more figures that we want to go through. So we're going to switch the conversation a little bit over to more talking about productivity and just how advisors are spending their time, how they're hiring in particular, and sort of overall staffing their business. So we're going to flip back up actually to table 3, page 17 on PDF numbered page 15. I know it's confusing. So 15 to 17-ish, go find it. Table 3 underneath staff productivity. So what this is showing is a very common business metric that we use to sort of gauge levels of productivity is revenue per employee. And, so Michael, in a very large firm, big firm that, my mom would have seen an ad for on the internet, or I'm sorry, on TV. Like, what's their typical revenue per employee? Like, what are they targeting? But really big RIAs.
So really big advisory firms, if you look at the broad industry benchmarking studies, you see advisory firms at scale are usually hiring a new team member about every $250,000 of revenue. Kind of varies by the study, anywhere from about 225 to 275, but that's a good rough middle-ish number. So just think like by 250,000 of revenue, I've hired my first assistant. By $500,000 of revenue, I've got 2 people. By $750,000 of revenue, I've got 3 people, and it grows and scales up from there.
And so I ask about that sort of for industry context of, for these bigger firms that are targeting sort of 250 to 300,000 in revenue per employee, and how that compares to our members who are obviously much smaller. They don't necessarily have 100 employees, but how their revenue per employee, themselves included, is ultimately showing up. So what table 3 shows is for the building and the scaling members. So again, building being 20 to 75 clients, scaling being 75 plus. Their revenue per advisor, themselves included, and then revenue per total staff. So this includes all of your admin operations, and this does include employed as well as outsourced, because we want to be, if you're have someone 20 hours a week but they're outsourced, like that's a half person.
Yep, that's a half person. So we count them. We literally count them as a half, just so we get the numerators and denominators right.
And what we're seeing is that our advisors are really matching industry standards when it comes to, or getting close to industry standard when it comes to sort of revenue per advisor and then revenue per staff. So, for the building advisors or building members, we're seeing they're averaging about $240,000 of revenue per advisor. Scaling members are about $310,000, which makes sense. They're growing and they are scaling. They have higher productivity per advisor. But what we are also seeing is that this per staff is going down. So 170,000-ish for building firms. Revenue per staff in a scaling firm is about 144,000, which tells me that, earlier on, you're more advisor weighted, right? That it's a much higher advisor to staff ratio. But as you begin to grow, you see revenue per advisor going up, but you're starting to hire more staff, more administrative staff, operations, compliance, whatever that is. And you start to see the revenue overall per staff coming down. Is that what you're seeing here?
Yeah, it's so a few things. Again, that number that I mentioned of firms overall on average tend to hire about once every $250,000 of revenue. That does vary quite a bit depending on the size of the firm in and of itself. There's a very clear trend out there in the industry. The larger the firm, the more those hires tend to space out. The smaller the firm, the more they tend to be bunched together. It's just kind of literally like there is a economies of scale that starts coming as firms get bigger, where once you've got a few team members in place, you can do a lot more with them before you hit the next complexity wall where you've got to hire another round of staff infrastructure to get to the next level. So the average overall is about $250,000 of revenue per employee, but firms in the earlier stages tend to need to hire much sooner. And so that's what's effectively what we're seeing here is when you're in those earlier stages, you're hiring staff. First of all, just our numbers overall are more in this 140 to 170,000 of revenue per advisor range, revenue per employee range. But what you get from that is as your team expands and you've got more support staff in place, you add more people to help get efficient, but you don't need as many advisors now, or you don't have to hire your next advisor as quickly. And so you end out with more team more team for the revenue that you're supporting, but higher revenue per advisor because you're getting more efficient. So I guess to put that in a slightly more practical terms, once you've got a couple of support staff in place, 2 advisors might be able to handle 125 to 150 clients. Before you have a support staff in place, 1 advisor probably usually struggles to handle more than 50 or 60 clients before they feel like they're drowning. So as you start getting support staff in place, you don't need to hire as many advisors, right? There's literally the leverage that you get by building a team before you need to hire more advisors. And so we see this effect playing out in the data where the more that the firm starts to scale up, they end out with more non-advisor staff, but they end out getting more revenue per advisor because their advisors are leveraged. They're leveraging themselves or they're leveraging their associate advisor with a support staff built around them.
What we found last year, I don't believe we have a chart on that this year, was sort of net revenue by stage of business. And what we saw was that as you get bigger, revenue goes up in those scaling phases, but net revenue per client comes down. Mm-hmm. Because in the end, exactly what you're talking about is that you have to start investing in infrastructure. And, we, as a business, you go through these phases where you have to heavily invest in infrastructure and it just tanks your net revenue. And then you're able to sort of build on that infrastructure for a while. Your net revenue goes up, then it comes down, then it goes up, goes down, it goes up. It is just the path that you ultimately take. And so I think we're seeing that here as well, is just, ultimately revenue per staff coming down does mean probably net revenue per client. All of those metrics are all tied together, just sort of different ways to slice the same data is coming down as well. So not that that's a negative.
I think the simplest way to think about this in slightly more practical terms is, so here's basically your path for growth. By the time you're hitting 150 to 200,000 of revenue, you need to hire a staff member to help. By then, depends a little bit on what your average revenue per client is, but if you're charging, we'll just call it generically, a few $1,000s per client, you are somewhere in the 50, 60 client range. There's a lot of people. There's a lot of people service. There's a lot of meetings to schedule. There's a lot of meetings to prep. They've got planning questions. It starts feeling very drowny. In fact, some advisors are already feeling like they're drowning by 40 or 50 clients, but you almost certainly get there by the time you're in the 50 to 60 plus range. So somewhere around that 150,000 of revenue or a little bit higher than that, you're going to start feeling like you're drowning. You need to hire a staff member. So once you hire a staff member, you get a little bit more breathing room. You can now start growing higher. You might get up to $300,000 of revenue. So now suddenly we're at 60 or 70 plus clients. But then we hit another wall because now you and the associate are handling stuff. You've handed off a lot of meeting prep and account forms and stuff like that. But there's a lot of plans to do. There's a lot of financial planning stuff to do. So you need some help there. So you hire a paraplanner. So once you hire a paraplanner, now there's one of you and 2 support team. So now you can get out even larger. You might get to $400,000 or $500,000 of revenue. By the time you get to $400,000 or $500,000 of revenue, though, now you might be approaching 80 to 100 plus clients. And just the sheer number of client meetings you need to have is too much. So then you've got to hire an advisor. So now you hire an associate advisor or an additional advisor person, or maybe your paraplanner promotes up to an associate advisor and you hire someone to backfill them. And now suddenly it's a 4-person team, you, an associate advisor, a paraplanner supporting you on the planning stuff, an operations person supporting you on the admin stuff. And now you can get up to $600,000 or $700,000 of revenue, which is essentially what we see for firms that are scaling. So if you got 2 advisors with $600,000 of revenue, you're at about $300,000 of revenue per advisor. And if you got 4 total team members with $600,000 of revenue, you're at $150,000 per staff, which is exactly what we see in the data. Now, once you get there, you got more capacity. Like that core team can grow quite a bit. Often you can get a lot further now before you have to hire your next staff member. And so once that initial infrastructure gets in place, that's often the size that scales firms all the way from 600,000 or 700,000 of revenue up to as much as $1 million plus. Depends a little on your revenue per client. But now you might get to 125 to 150 clients. Maybe you have one more admin person who supports, and now you end out at 5 team members, 2 advisors, you're getting up to $1 million of revenue. You're at $500,000 of revenue per advisor, $200,000 of revenue per staff. And you start getting a little bit more of that, what we truly call like scalability in the firm, which is same staff, more revenue, don't need to hire more people yet.
Awesome. Okay, so we have one more graph I want to go through before we wrap up.
Okay.
So we're going to go down to figure 33, down on page 30. Page 28, actually. And what this is showing is actually what I was alluding to earlier, but the data is a little different than we saw last year. And that is sort of the profitability profile of firms that are in the scaling phase, but they are either solo, boutique, or enterprise. So this is looking at those who have 75 clients or more. So they've really hit that point of, I would say, success. They're building the business the way that they want. They have decided to stay solo because at this stage, if you haven't hired yet, it's intentional. Right? You have made the decision you do not want to. And it doesn't mean you're not outsourcing, right? Solo practices are outsourcing a ton of stuff. But they've chosen not to hire. Obviously, your boutique and then your enterprise. And what we saw last year was there was, really revenue per client in an enterprise was much higher, but operating profit was much lower. This year, it is still the case, but it's a much closer sort of a closer profile. And so we're still seeing actually our boutique firms are driving more revenue per client right now. But your solo practice is making the least gross revenue, the least sort of fee per client of those 3 groups. And yet their operating profit is actually higher than the scaling firm. And then the boutique is sort of throwing this data off in a funny way this year, which is cool to see. And that is boutique firms actually have highest revenue and highest profit per client, which is, again, is just a little different from what we saw last year. But speaking specifically to solo, because, I think probably 80% of our members are solo. Probably about half, probably 45 to 50% intend to stay solo. So the question is, can I really earn a good living or being solo, or do I need to grow in order to be successful? Do I need to grow in order to make good money? Do I have to hire? And so what I'm seeing here is the answer is no. You can make a really great living being solo. So Michael, can you talk about sort of what you're seeing here in the data there?
Yeah. So I think there's a few things that crop up around this dynamic. And first, I feel like we have to asterisk this whole thing. Just when you put out there that comment around like make a quote great living. Great living is kind of relative. Like some of that's relative to just cost of living, right? Great living in the Midwest looks a little bit different than great living in downtown San Francisco. So do feel like we got to asterisk that overall. And just look, people have very different income goals. Like I've seen advisors who make $300,000 a year and feel like they're a failure because they're in a big firm where everybody else makes $500,000. And I've seen advisors out there who make $150,000 and are like, yeah, in my old career I made 60. Now I make 150 and I work 30 hours a week doing awesome stuff and my clients love me and I get to spend a ton of time with my kids and I make 2x the median household in the US. Like this is freaking awesome. So there is a little bit of difference here of just what does it take to get to 150 of take home pay versus 300 plus of take home pay. It does change this a little bit and I'll come back to that in a moment. But the essence of what we see is that advisory firms that are solos, particularly if you don't hire, you often start topping out at something like 60 or 70 clients. Just it gets harder to do more than that, if only because the admin and the meeting prep stuff begins to add up if you're not hiring or starting to scale yourself up. But when you're averaging $2,500, $3,000 of revenue per client, and some of our members are much higher than this, but if you're averaging $2,500, $3,000 of revenue per client, our data here was $2,600, and you're doing this with 60 plus clients, like boom, you're sitting right there at about $150,000 of revenue, and just aside from your perhaps wonderful XYPN membership fee that covers most of your technology, compliance support, and all the other stuff, like just there's not much else left. Like if you're not hiring up for the next level, there's not much else left. And if you want to figure out like how do I get to $250,000 instead of $150,000 of income, the default answer for the advisor is, well, I'm going to add more clients. But what we just talked about is you want to add more clients, like you want to go significantly higher. It's time to start hiring, which means of the next $50,000+ that you make, you don't keep any of that. It all goes to your next staff member. Like you got to make $80,000 or $100,000 just to get the last 20 or 30 grand after the person, their training, their employee benefits, their payroll tax, all the other stuff you got to do when you hire a person. And just that's the nature of what happens when you start truly scaling a business, which is, I think a lot of us tend to forget as advisors. Like when you do the first stage, it's great. Every client you get, 100% of the revenue that comes in drops straight to your bottom line. Once you go beyond yourself, every time you add more clients, you're going to have to add more staff. Maybe not, obviously not one-to-one, but every 20, 30, 40, 50 clients, you got to add another person. And so then a big chunk of the revenue that you added goes back into hiring the next person. And suddenly you're only making 20, 30, 40 cents on the dollar for every dollar that you grow, instead of making 100 cents on the dollar for every dollar that you grow. So a lot of members choose not to do that. They keep this solopreneur practice. But the key takeaway for it is, what that means is if you're staying a solopreneur and you want to grow, it's all about how do you get higher revenue clients. Because you can't get more. More means hiring, and hiring means you don't necessarily take home more. It's all about how do you get higher revenue clients. I mean, not that you have to. If you're happy with where you are and you're happy with how the math adds up, more power to you to hang out in your business model. But just there's a mindset shift that has to happen. I mean, the simplest version to think of it is just, if you're a solopreneur and you want to grow as a solopreneur, one on, one off. You get a new client on, you got to take a new client off. So ideally, you get a client who's above average, you remove whoever is your least favorite client below average. There's always one, at least one.
Or we could frame that as you can allow a client to graduate beyond your services and connect them with an advisor who specializes in working with clients like them. We don't have to talk about, this isn't an instance of firing a client because they're not a good client. It's like, this is revenue per client, and yeah, your lower paying clients, you can be able to connect them with an advisor who's really focused on them. So just as a way of framing that.
So once you grow beyond that, though, it gets more expensive. And to me, just one of the most straightforward metrics that we get straight out of the data here is, as you go from solo to boutique to enterprise, your overhead expense goes up and up and up. It just the bigger you want to grow, the more staff infrastructure you need, and it adds up to more. And so that's why what we see at the end of the day is the firms that are scaling make less profit per client than the ones who are not, even though they're charging more. They're charging higher fees and taking home less money. Because it costs money to scale. You make fewer and fewer dollars the bigger that the fewer dollars per client, the bigger the firm gets, which means you have to work harder and harder to get a whole lot of new clients just to make a little bit more in money. And just that's the nature of what really happens when you're scaling a business. So the good news is you can scale it much, 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 much bigger if you want to, but it's a very different job and pathway than I'm going to get my 50 great clients, and then over time I'm going to get 50 slightly greater clients by moving up market if your goal is to grow your income.
Yeah, and worth noting that we're talking a lot about income here. We are not talking about the value of the business, which is going to be significantly higher if you are 4 times, 5 times, 6 times higher. We're even a slide I recently saw from some data is how the multiples, sort of the valuation of the companies, just the overall multiple profile is going up with the bigger firms. I'm not sure if that's applicable inside the sort of under 5 million in revenue businesses, under 1 million, that sort of thing. It was looking at like really, really big firms over time. But, that growing will potentially provide you more enterprise value, an asset to sell one day, or if you were to pass away, an asset that your heirs are able to do a transaction on. However, we're really focused on income here, which is what's ultimately impacting your day to day. So,
well, and again, just important to recognize, like if you make less revenue per client for long enough, like, the asset you sell in the end isn't like, you don't finish with more money. It just makes back all the money you didn't make by earning lower income for all the intervening years that you were growing and scaling. We've long remarked on this in some of the Kitces research data that we collect as well. The top income solo advisors have more take home income than partners in $1 billion advisory firms. Mm-hmm. And we've seen that data show up year after year. And the path from being a solo to $1 billion makes significantly less income for what could be 5, 10, 15, 20 years sometimes that it takes advisors just to grow slowly and steadily to get to $1 billion. And so it's like, the good news is you own the $1 billion firm. The bad news is you made several $100,000 a year less for 20 years in order to get there, which means you've walked away from what could be $2 or $3 million of income. So I hope we have a significant enterprise at the end, because you need that just to make up the income you didn't get along the way. And so not to be totally negative for building and scaling a business, obviously, right? Like Alan, you and I, like we actually do a lot of this of building and scaling. There is a point where you can grow just faster than the average firm, genuinely get ahead of that curve, and you can create some real enterprise value above and beyond the income trade-off. But the subset of advisors who really actually truly want to do that, like really invest your time and become the manager and the CEO, and probably not really see clients much anymore because you've got a lot to do to run and scale and grow the business. There is a small subset of advisors out there that I think are truly wired for enterprises. But I think a lot of us just, the industry is so obsessed with putting people on the pedestal who have the biggest, fastest growing firms that we often don't get to what's happening beneath the surface, which is they're taking home often way less money and working a lot more hours and spending a lot more time and are a lot more stressed to maybe net more money than they would have by just staying small and lean with a focus on higher income clients that can make them more money along the way. So you can build whatever you want at the end of the day, but like get clear on why you're doing it, because the data does show pretty clearly here that the faster you're trying to scale that enterprise, the more overhead expense you've got and the less profit per client you get. Even when you're charging more, you have to charge more just to try to get back close to where you would have been if you weren't growing in the first place.
Absolutely. The beauty of this business is you really can build the business that you want that ultimately supports your great life. And the truth is that's why XYPN exists. It's not just about, being sure you get a firm started. It's about being sure you're being really intentional about what kind of firm do you want to build and why for this stage of your life, and that your life stage changes. Kids are born, kids get older, you get married, you get divorced, you move, like you want to be remote for a while, you want to be in person, like things change over time. But being really intentional about what's the business you want to build, and recognize that, we have advisors who are very successful in all areas, whether they choose to stay small, grow big, hire people, not hire people, continue to grow up market with higher paying clients, not growing up market and continuing to stick with clients that they started with. So the point is not that there is a right or wrong or good or bad. It's all about being really, really intentional about the business that you ultimately want to build. So Michael, thank you for taking the time to join us.
Absolutely.
And I guess, who knows, maybe it'll be next year before we see each other on here again. But thanks everybody for tuning in and,
awesome.
For this discussion with myself and Michael, just talking about our 2020 benchmarking study results. So thank you all. And Michael, we'll see you next time.
Awesome. Thank you, Alan.
Tax planning and preparation is an enormous value add for your clients, but taxes can very quickly become overwhelming as an advisor. XY Tax Solutions is the tax team in your corner that works with advisors to offer expert tax services to their clients with 3 different client engagement options to choose from to meet your unique needs. Partner with XY Tax Solutions to integrate tax preparation and planning into your firm, and don't sweat tax time this year. Visit xyplanningnetwork.com/XY Tax Solutions to learn more. Be sure to join our VIP community at xyplanningnetwork.com/VIP to hang out with other XYPN radio listeners, ask questions for future mailbag episodes, and finally, to find a community of like-minded financial advisors. Thank you so much for joining me today. We'll see you next time.
You are not alone and you are not crazy. It's scary starting, building, and growing your own financial planning firm, and that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to xyplanningnetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.